YieldMax ETFs are purpose-built for one thing: income. With strategies that write options on highly volatile stocks, they often deliver jaw-dropping yields. But yield without context can be misleading. In today's video, we'll explore which YieldMax ETFs have paid the most since their inception, why those yields have been so high, and whether they're sustainable. You'll walk away knowing exactly where the biggest payouts are, and whether they're built on rock-solid foundations or sand. Let's cut straight to the chase. Which YieldMax ETFs have delivered the highest distribution since launch? According to YieldMax press releases and ETF data, SMCY, the SMCY Option Income ETF, has a distribution rate of roughly 101% or more. MSTY, the MicroStrategy Option Income ETF, is close behind with about a 90% distribution rate. AIYY, the AI Option Income ETF, sits around 84%, while ULTY, the Ultra Option Income ETF, has delivered around 83%. LFGY, the Crypto and AMP Tech Portfolio ETF, has offered a distribution rate of about 61%. These huge payouts are driven by two core factors. The first is high underlying volatility. Selling options on volatile names like MicroStrategy, SMCY, or AI-related stocks generates massive premiums. As Barron's reported, MSTY leverages MicroStrategy's massive swings tied to Bitcoin exposure, leading to yields near 160% annualized in recent months. That's income built on volatility. The second factor is return of capital dominance. A significant chunk of these distributions are not from earnings at all, but from returning your capital. YieldMax discloses that many funds, including AIYY, MSTY, and others, regularly pay out substantial portions as return of capital. That means your account gets credited, but your base investment might shrink over time. Looking at the Inception timeline, AIYY launched in November 2023. MST followed in February 2024. SMCY, ULTY, and LFGY all debuted between 2024 and 2025 during a wave of high volatility ETF innovation. That means these funds have delivered their record payouts relatively quickly, within their first year or so. The markets have rewarded volatility, and YieldMax turned that into payouts. To unpack what the numbers truly mean, take SMCY's 101% payout. That means if you invested $100, you got $101 in distributions over the last year, but much of that money includes return of capital, which shrinks your base. MSTY generated nearly 90% payouts via premiums on MicroStrategy volatility, but if that volatility subsides, so will the income. AIYY and ULTY follow similar scripts, with volatility baked into yield but potentially fragile. LFGY, the crypto and tech basket, is the same story: high rewards, high risk. These are not your traditional dividend ETFs. Sustainable income ETFs like YieldMax or SCHD yield 7 to 8% with stable asset bases. These YieldMax heavyweights rely on volatility premiums, and those premiums can vanish. If markets calm or volatility drops, the income can dry up. Plus, as return of capital continues, your investment base can erode unless the ETF's net asset value rises to offset it. For investors, that means these funds can be powerful income engines, but only if you know what you're buying and you're comfortable with the risk. High-risk, high-yield appetites may gravitate toward MSTY or SMCY for explosive income, but you must be ready for equally explosive volatility. More cautious investors might consider newer, lower-yield YieldMax funds or stick with mainstream income ETFs. And no matter what, always monitor whether distributions are backed by true income or mostly funded by return of capital. A good rule of thumb is to always check both the distribution rate and the 30-day SEC yield. The distribution rate shows what's being paid out, including option income, while the SEC yield focuses on net investment income. Together, they tell you how much of what you're receiving is sustainable versus how much is simply a return of your own money. To recap, The top payers since inception are SMCY at around 101%, MSTY at about 90%, AIYY at 84%, ULTY at 83%, and LFGY at 61%. They delivered these payouts quickly by leveraging volatility, but those payouts lean heavily on return of capital. So yes, the returns are real, but walk cautiously. High yield does not always mean high profit. High income is exciting, but sustainable income is what most investors truly need. If volatility normalizes, or if the underlying stocks settle into tighter trading ranges, those distributions will likely come down. For that reason, YieldMax's highest-paying ETFs are best suited for investors who can actively monitor their positions and handle significant swings in both yield and price. At the end of the day, YieldMax ETFs offer a buffet of income opportunities, from explosive high-yield options to quieter, steadier strategies. The key is matching your investment goals to the right strategy: income versus sustainability, volatility versus predictability. If you're looking for the biggest payouts and you understand the risks, funds like SMCY or MSTY might make sense. But if you're looking for stability and a lower risk income stream, a more modest YieldMax option or a traditional ETF like JEPI could be a better fit. Let me know in the comments which YieldMax ETFs you're following or holding, and what your experience has been with their payouts. Thanks for watching, and I'll see you in the next one.